Hey guys, it's Big Mike, and like always, I'd like to thank you for being here today. Today we've got a webinar from BMT user Ron99, and he's going to talk about trading options on futures. Some of the bullet points that he's defined are buying and selling options on futures, talking about premium, margin, spreads, comparing options on futures to other products, and options by commodity. Ron has asked that if you guys have questions relevant to what he's talking about right now, that you can type them in and we'll try to get them answered. Otherwise, we'll have a Q&A at the end of the webinar for any other general questions. The webinar is being recorded, and I'll post the recording on BMT sometime tomorrow. And with that, let me turn things over to Ron. Okay, Ron, you should have the option to show the screen.
Okay, that's not working. There we go. Hi, I'm Ron. I'm going to lead you through options on futures primer. This will be for very beginners, people new to options, and try to explain what they are and cover different commodities, and then towards the end we'll cover why you should want to be selling options. First of all, what are options on futures? A lot of things there. Puts, calls, premium, margin. There's expirations. We do spreads and things like out of the money, in the money, at the money. Options are like flood insurance. The buyer of flood insurance will be paid if the water moves into his home, like this example here. The buyer of an option will be paid if the futures expire past the strike of the option, just like the buyer of flood insurance gets paid if his house flooded. Below the put option strike price, you get paid, or above the call option strike price, you get paid. In this example here on coffee, the person bought a 130 put option, and the futures ended up at 122.25. So he made $7.75 minus the cost to buy the option. The seller of flood insurance keeps the premium if the house does not flood by the end of the contract period, no matter how close it gets. The seller of options keeps the premium if the expiration of the futures is above the put strike price or below the call strike price. So in this example on ES or E-mini S&P 500s, if you sold a 1650 call, it's out of the money because the futures ended up at 1557, you would keep your premium. If you sold a March 1400 put, you would also keep all the premium you sold it for minus your costs because that's below the 1557. All options have expirations dates. They are all set time period that they trade. Most options settle monthly, but now there are also options that settle weekly, and there are also end of the month options. Premium. Premium is the price of the option, or in the case of the flood insurance person, that's what you pay to be covered for that period. The lower chance of the insurance or the option being used or the option going in the money, the lower the premium. So like in this example, the people higher up the hill or the people further away from the future strike price, they would have a lower premium or lower flood insurance premiums. The people down at the bottom of the hill next to the river are going to have higher flood insurance premiums, or the people that are selling options close to the future strike price, the people selling options, their strike price is close to the futures, they will be, that'll be a higher price premium on those options. Premium is also affected by dates of expiration. The further from expiration, the higher the premium. and that's called time value. In this example here, on June 21st, the July 1400 put was priced at 230, which is only 28 days till expiration. August 1400 is at 7. September 1400 is 13 and a quarter. October 1400 is 1925. So as you can see, the time premium on those options is quite a bit, roughly about 7 per month in this example. Margin. What is margin? Performance bond margin is the amount you are required to post to sell an option. Margin, one example is margin is like security deposit when you rent an apartment or home. So that if something goes wrong, the owner of the apartment or home will take your security deposit to cover if something drastically goes wrong. Well, the same thing with margin. You put margin up when you sell the option. You don't put any margin up when you buy it, only when you sell it. And if the futures start going the wrong way for you, then your margin will increase, and it finally gets to the point where you may end up on a margin call. Option margin is always less than the margin for a futures contract. It can never be higher on single contracts. How is margin calculated? Our option margin is calculated daily using CME's proprietary SPAN program. Some brokers have the margins available through their data platforms. You can also buy the SPAN program, which a few years ago was $500, and sometime this year they actually lowered the price to $10. Now I will warn you that the PC SPAN program is 25 years old, and it hasn't had many revisions since then, so it is not easy to use, but we are working on it. There's actually a thread called PC SPAN where we're working on being able to use Excel, accessing the daily files, and able to calculate our margins ourselves without using the PC SPAN program. Some of the factors used to calculate option margin are the option strike distance from the futures price, which we covered earlier with the hill and the flood diagram. There's also the days till expiration, or DTE. And there's also the volatility. And today was a very prime example of volatility in the natural gas options. They were much higher priced than what you would normally expect for them because of all the volatility that's been in natural gas lately. And there's also broker multiplier. Some brokers charge more than the SPAN margin. Everybody's required to charge the SPAN margin. They can't charge any less, but some brokers will charge more. IB is a prime example of charging, 2, 3, 4 times as much margin on options as SPAN minimum. So your main goal is to get a good rate of return, and if you're having to put up more margin for every option you sell, your rate of return is going to be lower. So your goal is to be at the lowest margin possible. So if you're wanting to sell options and you want to get the best rate of return, maybe being at IB would not be the best place for that. After you sell the option, the margin amount for that contract is subtracted from your balance, reducing the amount of money you have available to make another trade. In this example here, the person had $10,000 in his account. The margin required for the position he had on was $1,500, so that left him with $8,500 available to sell more options. It's subtracted right from your balance. As the margin decreases, hopefully, if your things are going your way, the amount available to trade increases. So if it wasn't, if you started off with 1,500 for that contract and now it's down to 750, you now have 9,250 to trade. So that varies. It could also go the other way, and you could have less to trade because the margin increased. And that is changed daily, usually overnight. Now, when you're selling options, you should always keep cash excess in your account. Never use all of your balance to cover margin. For me, I like to be safe, somewhat safe, and I use 33% of my balance to cover margin. And that leaves 67% in cash. The reason for the excess cash is to cover when the markets go against you or the margin is increased by the exchange or by where you're trading at, for example, IB or Options Express. There's no rhyme or reason. Usually when things get more volatile, they increase it, and then when things are less volatile, they decrease it, but sometimes there's no rhyme or reason when they do that. So you don't want to have to close a position just because of temporary movement in the markets. So that's why you have the excess, so you can ride things out. You don't want to be forced out continually of positions. Nothing is more frustrating than having an eventual winning position on, but having to close it at a loss because of a temporary market spike, and then have the market immediately turn around and your position never went in the money and would have been profitable. If you don't have enough cash excess in your account, you risk the dreaded margin call. A margin call was the amount of margin required for your current position is less than your cash balance. Here's an example. Well, examples later. You'll get nasty emails. They are very strongly worded emails or calls from your broker telling you to send more money immediately. Or some brokers will place market orders to remove positions from your account. IB is one that does that. You do not want that to happen because market orders on options are not the thing to do because most of the options are thinly traded, so you could really get a poor fill if your place get traded out of position by a market order. The best way to deal with a margin call is to trade out of positions to bring your margin required under your cash balance. That's the best way to deal with that. Okay, here's the example. On April 11th, the margin for a June 1300 gold put was $367. The premium was $50. And in this example, we're using the guy has a account balance of $5,000. So you take 367 from the 5,000, and he has an excess of 4,633. But then, the next 2 days, gold dropped $203 in 2 trading days. That was a Friday and a Monday. The margin on that put went from 367 to 3,170. The premium went from $50 to $3,040. So the premium went up $2,090. You take the $2,090 from the 5,000, that leaves your balance at 2,010. And then you compare that to the margin required of 3,170, and your excess is red, 1,160. You are on margin call. So even with 67% cash in my account, I still would not have been able to ride this out, and I would have had to bail on this position. And in fact, I did have some and did have to do that. Okay, expiration on options. When an option is held through the last trading day, if it is out of the money, the option expires with a value of 0. So if you sold it, you keep all the premium minus the cost to sell it. And usually when options expire that you are short, there are no costs involved, but there may be cases where there are. And as I was saying before, no market orders on options. There just isn't enough volume with most options to place market orders. I always place limit orders. So that also means no stop orders, which would be nice to be able to do them, but other than maybe a market that's extremely extremely highly traded but big volume like ES, I would not place stop orders anywhere when selling options or buying them back. Placing orders. Most times you'll be able to place an ask halfway between the bid price and the ask price and gets filled, but that varies by commodity. Experience will teach you what to do with most commodities. Depends how quickly you want to get in, get out. Depends on the commodity. It just takes experience to know which ones you can go halfway between. Like ES, you can usually go halfway between. Natural gas, you can usually go halfway between. Crude, more often than not, you've got to actually hit the bid. They don't actually come up to you. It varies by commodity. So it'd just be a good idea to watch the screens, see how it's trading, see how the fill compares to the bid and ask, and gain experience, and that way you'll know best how to place the orders. One formula I use to determine the fair price of an option at that moment is to multiply the delta by the amount the futures price is different than the previous day's settlement and add that to the option's previous day settlement. In this example, we'll say crude settled at $100, and that was just prior trading day. Today, it's at $100.50, so the futures change is plus 50 cents. The option we're currently looking at had a delta of 0.02, and the previous option settlement was 5 cents, 0.05. So future change times delta, so that would be 50 cents times a delta of 0.02 would equal 1 penny or 0.01. You add that to the previous option settlement of 5, and so the fair price for that option at that moment would be 6 cents. On days when markets are moving really fast, that'll give you a pretty good idea what the price should be and how you should place your bid or ask. Now, a day like today in natural gas, you had to go much higher than the fair value because of volatility. It was taking that up even higher. So what's happening in the market also will determine that. But on most days, this formula works fairly well. It is usually best to trade the major strikes of options because of volume. But again, that depends on commodity. On ES options, you could trade any strike because there's so much volume in the whole complex. But a lot of other commodities, that's not really a good idea. Here's an example. This is March crude oil puts. And as you can see by the red arrows, the numbers 50, 60, strikes 65, 70, 75, 80 all have open interest in the thousands. Whereas in between them, there's hardly anything there, 12, 13, or nothing at all. So if you want to be able to get in and be able to get out, you want to stick with the strikes that have more volume in them. And in crude, that would be on $5 increments. For some commodities, the futures are not every month of the year. They're quarterly. Some of them are depending on the seasonality of that commodity, but there are usually options for every month of the year. There will almost always be more volume and open interest in the options with the same month as the futures. And here's an example. March corn has 3 months of options trading under it. January options, February options, and March options. And they all settle to the March corn futures. But the March options will have the most volume and open interest. On last Friday, corn calls, Jan, there were 44,988 open interest. February is 44,000. But as you can see, March, which is 3 months out there, it's 5 times as much open interest on the March calls than there was on Jan and Feb. So to get your best volume, get your best fills, it's best to go with the month that the futures they're trading at when you're doing the options. Okay, now we're going to have a little quick discussion of options by commodity. I'm going to cover the major commodities and the option trading in them and the quirks of each of one of those. The big daddy, you might say, is the ES contract or the E-mini S&P 500 monthlies. They have over 3 million open interest. The calls and puts trade 100,000 or more most days. On those you can trade any strike because of the good volume. There's decent return on investments on puts because the premium is kept a little bit higher there and further out because people are more worried about the stock market going down than they are making a quick move up. So thusly, there's a low return on investment on the calls, and you can't get as far out of the money on the calls. The OS contract is the full-size S&P 500, 3 to 400,000 open interest, 15 to 20,000 trades daily, but that is only traded in the pit. There's no electronic trading on full-size S&P future options. EW contract, that's the E-mini S&P 500 end of the month contracts, and there's also weekly contracts, so it'd be EW1, EW2, and EW4. The end of the month, about 200,000 open interest with 5 to 10,000 trades a day. The end of the week ones, they'll get up to 200,000 to 300,000 open interest for a week, and there's 40 to 50,000 trades daily for the week that's currently being traded, the close-in one. QZ is E-mini NASDAQ, about 50 to 70,000 open interest, only 3 to 5,000 trades daily, but it does have decent return on investment, but just not as many trades there as the ES contract. FX options. I don't do any of these, but I will list them here because I know a lot of people do trade those. Euros have the biggest traded one, are 180,000 open interest, 11,000 volume roughly. Obviously all these volumes and open interest vary throughout the year. Some get higher, some get lower, some are about the same year round, but this is what I picked up from last week. Yen 106,000, 9,000 volume. Aussie dollar 63,000 open interest, but only 3,000 volume. British pound 60,000 open interest, 9,000 volume. Canadian dollar 41,000 open interest, 4,000 volume. 10-year notes, quite widely traded, 2.3 million open interest, 500,000 volume, but of that 500,000, 250,000 of it is Globex volume, the rest is pit traded. So when you're looking at total volume on some of these, you need to make sure you look at and see if it's pit traded, private negotiated traded, or Globex traded. Most of the people listening to this are probably going to be looking at Globex trading, the electronic trading. CL or crude oil, 2.3 million open interest on the calls and puts, 75,000 volume, and that can vary quite a bit. Probably a bottom would be 50,000, but a high, you can easily get 150, 200,000 traded in a day. Usually about half of that is Globex, the rest is pit traded, and it has a pretty decent return on investment on crude oil. Natural gas, 300,000 open interest, 30,000 trades a day. Very good open interest, return on investment on that one. But on those, you need to use extra cash excess because option prices and margins move quickly. And I wrote this over a week ago before all the craziness has happened the last few days in natural gas. But it just seems like the margin moves a lot faster in natural gas, and also the premiums move a lot faster in natural gas than they do in other commodities. So you need to be careful there when you do trade those, but you can get a good rate of return when things are going well there. RB and HO, unleaded and heating oil, 55,000 open interest on unleaded, but less than 500 trades a day. I mean, there's just not much done there. Heating oil, only 35,000 open interest and less than 500 trades a day. It's just very thin market. There are some decent return on investments, but if you sell an option there, you're pretty much going to be stuck with it because it's not going to be easy to get in and out. So you want to be really far out of the money, and just if you do them, just plan on holding it right away so you're not going to be able to bounce in and out of those easily at all. Grains. Corn options at 1 million open interest, 34,000 volume per day. Beans, 574,000 open interest, 48,000 volume per day, a little bit higher ratio of volume to open interest on beans than is corn. Wheat, 256,000 open interest, 16,000 volume. Bean meal, 135,000 open interest, 8,000 volume. Right now, grains are a low return on investment. A lot of commodities are cyclical on how good their rate of return is. Right now, grains are just a little bit off. Other times of the year it can be better, but like I say here, it can be very volatile during the U.S. growing season. That'll improve your return on investment, but it also makes it a lot more riskier when it moves around. I mean, a rain or lack of rain, too much heat, too little heat, that all affects it, and the markets are moving on every weather report in the grains. But you can do some stuff there during calmer times. The livestock. Cattle and hogs are about 170,000 open interest each. 7,000 volume on cattle, 6 on hogs, and that varies per day. But on the livestock options, you can't really get very far out of the money when you're selling those options because they just don't trade. So it's a little bit riskier because you're going to be trading closer to the money, and you can get hit a little easier there. But certain times there are some good stuff there, and you can make some good money on this. Metals. Gold, 1.4 million open interest, 20 to 50,000 trades per day. Silver, 183,000 open interest, 8,000 volume. Copper, only 2,000 open interest, and you're lucky if you see 100 contracts trading a day. I don't know why, but copper options just nobody trades them. And then lately the return on investment has been low for the metals because the margin, after being raised when we had all the dramatic moves earlier in the year, they just haven't lowered the margins yet. So that makes the return on investment really poor, and I haven't done metals in months now because of that. It just seems like COMEX is really slow at adjusting their margin rates, and they really need to lower them now, but they're a little bit behind. Ice softs. Majority of them have extremely good open interest, but some of them are low volume, so you got to be careful there. Cocoa has 100,000 open interest, about 6,000 volume per day. Coffee, about the same, 100,000 open interest, 3,000 to 5,000 volume per day. Cotton, 150,000 open interest on the cotton options, 6,000 volume. Orange juice, 20,000 open interest, maybe 500 volume. That one I would stay away from. There's just not much there, and that market is extremely volatile. Worried about frost in Florida, worried about hurricanes in Florida, enough rain. That one's a one to stay away from. Sugar has huge open interest, 580,000 for the softs, 25,000 volume. But on sugar, like right now, it's been kind of less volatile in sugar. You cannot get very far out of the money on those either, so you're going to be playing kind of tight if you're selling options there, and that will make it more riskier. Coffee used to be one of my best, by far, markets for selling options, because when coffee was trading in the upper 100s, like 180, you could sell $300 calls, make a very good return on investment on them, and have plenty of buyers. But since coffee has been down here at the low 100s, and there isn't much prospect of things changing in the short term, I mean, all the call buyers are just gone, totally gone. I mean, it's rare to see something trading above 130 now in coffee. So right now, I just have to not play that market. But it's interesting how some markets you'll be able to trade them really heavily, do really well, and then a few months later, there's nothing there, just nothing there. It just totally changes like that. Coffee puts over there, you pretty much got to be really close to the money there, and so those are a little on the risky side, but the big money is in the coffee calls when they start trading again. Okay, why sell options on futures? Options on futures, your profit is limited. You can only make what you sell the option for. That is it. You get nothing more, no matter what the price does. And also, the loss is potentially unlimited. If the markets go against you, the premium will just keep climbing. Like we saw in that gold example, it could just skyrocket it. Now, there are ways of preventing an unlimited loss, and that's doing covered calls, and maybe in another presentation we'll cover that, but I'm not going to quite get into that here. But that would be where you sell a call or sell a put, and then sell or buy an option further above that, either a call or put, and so that would limit your loss. But it also reduces your rate of return and reduces your profit. But selling a naked option, your loss is unlimited. The best reason to sell options on futures is because you don't have to be 100% correct on the direction of the futures. There's some room for margin for error there. If you buy or sell a future contract, the market has to move in the correct direction or you'll lose money. If you buy a future, price has to go up or you're going to lose money or make nothing. If you sell a future, the price has to go down for you to make money. So there's no wishy-washy there. It's got to move in the direction you are positioned. If you buy an option, the futures have to move in the correct direction that you bought the option and move faster than the time decay of your premium or you'll lose money. If you go out and buy a 97 crude call right now, we'll say 98. If you buy a 98 crude call now, futures have to go up, and they have to go up more than time decay or you lose money. But your loss is limited to what you bought it for. If the futures go below 97, you're going to lose money, and if they stay below 97, you're going to lose money. So that you have to be exactly correct on the movement of that market. But if you sell options, The future contract can move somewhat against you, and you will still profit from the positions. For example, let's just say that this is the December crude contract, and on September 3rd, the futures were at 106.42. And on that day, you thought that crude oil futures were going to be going higher. So you sold a 75 put for 8 cents. Well, over the next 2 months, futures dropped to 94.61, which is $11.81 lower. So you were totally wrong on predicting the direction of the futures. But if you look at the green line here, that's what the premium of the 75 put did. And it basically just went straight downhill, even though futures were going the wrong way on your option. And even you can look at it, I mean, there's only up here at the top, there's one 2-cent move against you, and then there was, a few 1-cent move against you, but you were totally wrong on predicting the future direction, but your income on the selling the 75 put was just gradual profit through the month, and you ended up claiming all your money at the end, the 8 cents that you sold it for. So that is the biggest advantage of selling options, is you do not have to be 100% correct on the direction. You just have to be far enough out of the money, and you don't need a huge quick move in the future against you, and the option premium, the time decay, will just wipe that out. So you can be wrong when estimating futures direction, but still make a tidy profit on your position. One thing I do want to point out, though, is I don't have a slide for it, but time decay on most options is between the majority of it, the quicker time decay, they'll show you a graph, it's from 90 days down to expiration is when the time decay starts increasing and your premium starts decreasing. But that is also affected by how far out of the money that is. So like if you're selling 1,300 ES puts, which are way out of the money, almost, 470 today, those, the time decay will happen sooner because they're further out of the money. Whereas if you sold a 1,550 put, the time decay will be happening later on that because it's closer into the money. So the time decay varies on these options based on how far out of the money they are, and also the volatility in the market at that time. So trying to pick the sweet spot of selling it right before the time decay, but also the futures are going your right direction, is something that takes years to learn, but it can be done, and you can also profit pretty well from that if you time those just right. And that's the attraction of selling options on futures. I guess I will open it up for questions here.
Okay. All right, guys, so go ahead and type your questions if you have them. Lewis had a question from earlier on. He wanted to know if you know about Interactive Brokers' portfolio margin and how it might apply to options and span margins.
I've never traded at IB because of their high options, so I can't really answer that question. I do know that on futures, I mean, they'll be 5, 6, 8 times as much as span minimum margin. Basically, they don't want option sellers there.
Yeah, I know, Lewis. There's there's an option in TWS that lets you see what your portfolio margin would be. So maybe that can tell you what the margins would be for options. Okay. Tom wants to know, is it practical to buy options in lieu of using stops on futures?
If you're, well, depends on what we're working. If we're talking about buying to get out of your sold option, I mean, sometimes that's what you have to do. But you can also buy a further out of the money option to cover your potential losses on a thing, and that's various things are called covered spreads or verticals. It does work, but you're gonna get back some of your possible profit and lower your rate of return, but it does reduce risk, and you have to decide which is more important for you.
Okay. Harvey is wanting to know if you use the VIX to judge an entry.
I don't, because majority of what I do, I'm so far out of the money that I just want to get a position on. I can't be playing with hoping that there's going to be there a certain day or not there another day. Now, if you're doing the more trading and the more contracts with more volume, like ES or crude, something, or the bonds, then yes, you can. You should use the VIX, and well, you don't have to use the VIX, but it would help improve your profit potential.
Okay. Ron, I don't have any other questions right now. And I've got a bit of a family emergency that has come up, so I really need to get off the webinar. So I'm going to just ask anybody that has any further questions to post them in the webinar thread, okay?
Okay.
All right, so Ron, I appreciate you putting together the presentation for us, and I'll post the recording as soon as I can, guys. Thanks, Ron.
Mike.
Thanks.